Welcome back to Silver Fault Line. If you told me a week ago that the global silver market, a market so large, so deeply wired into finance, industry, and sovereign reserves that it's basically part of the plumbing of the modern world, could be kicked off. Balanced because the President of the United States decided he wants to buy a frozen island in the North Atlantic, I would have said you're watching too many conspiracy documentaries and not enough reality. But here we are. It is Monday, January 19th, 2026, and the tone in the world has shifted. By now you've seen the headlines. The mainstream media is doing what it always does, turning something enormous into a punchline, late-night jokes, clips of angry Danish politicians, smirking anchors. The narrative is simple. Trump wants to buy Greenland again. They'll keep it right there, because that's easy, that's clickbait, that's safe. But while they're laughing, the bullion desks in London and New York are screaming, and not because of Greenland as a concept, but because buried in the same announcement is a single policy line that blows a crater into the logistical foundation of the global silver trade. A 10% tariff on all imports from 8 European nations, including the United Kingdom, starting February 1st. And if a Greenland deal isn't reached, that tariff escalates to 25% on June 1st. To the average person, that sounds like politics and posturing. To a risk manager at a major bullion bank, JP Morgan, HSBC, Standard Chartered, the large clearing members, that's not posturing. That's a structural break. That's the kind of rule change that turns yesterday's hedge position into tomorrow's existential crisis. Here's why. The global silver market runs on one sacred assumption: fungibility. The idea that a 1,000-ounce bar in London is economically identical to a 1,000-ounce bar in New York. Not similar, not close enough. Identical, same metal, same value, same ability to settle obligations. But fungibility is not a philosophical concept. It's not a textbook definition. In real markets, fungibility is created by logistics. It's created by the ability to move metal between the major hubs cheaply, reliably, and fast enough that the price can't meaningfully diverge. London and New York are the two Western anchors. London, through the LBMA ecosystem, is the physical nerve center. New York, through COMEX, is the futures casino that still sets the headline price most people see on a screen. Those two worlds have been stitched together by a constant transatlantic flow. Metal moving, ownership swapping, inventory shifting, bars being flown, refined, recast, reassayed, and re-registered, depending on where the stress is. The banks have a game they play. Everyone on the inside knows it. It's not even secret, it's just ignored by people who don't want to understand it. When New York gets tight and the price threatens to rise, London inventory becomes the fire hose. Metal comes out of LBMA vaults and gets moved into the US pipeline to smother the squeeze. When London gets tight, which it has been repeatedly because Asia has been vacuuming physical, the banks do the opposite. They pull metal out of COMEX-related warehouses and shift it back across the Atlantic. It's a whack-a-mole system. The moment one side starts popping up with real stress, they smack it down by relocating supply from the other side. That game only works if you can move the metal without a penalty so large it destroys the economics of the move. Now imagine what a tariff wall does in the middle of that system. The United Kingdom is on the tariff list. London is the LBMA's home gravity well. That means starting February 1st, silver coming into the United States from the UK becomes tariffed. And more importantly, this is the part the media will never explain. The moment that risk exists, it changes the calculus of every location swap and in every temporary shipment decision the bullion banks make. Because the entire system assumes reversibility. In a normal world, you can send metal where it's needed today and bring it back later when the pressure shifts. The ability to reverse the move is what makes it safe. That's what allows banks to run global books, hedging one jurisdiction against another, pretending the ocean doesn't matter. But a tariff makes reversibility expensive, sometimes catastrophically expensive. Let's put it in plain numbers because spreadsheets are where empires die. If silver is $90 an ounce and a bank ships 1,000-ounce bars to London and later needs to bring equivalent metal back into the United States from the UK, a 10% tariff is effectively a $9 per ounce hit. On 1 million ounces, that's $9 million. Not a nuisance, not a rounding error. It is the kind of cost that vaporizes the thin margins of bullion banking and turns a routine logistics adjustment into an equity-threatening event. And if that escalates to 25%, at $90 silver, that's $22.50 per ounce. You can't hedge that away with a clever option structure. You can't offset that with a minor premium change. That is a guillotine. So what happens psychologically inside the banks, and this is the part that matters right now, is that risk managers don't wait for February 1st. They don't wait for June 1st. They issue stop-move guidance immediately because the uncertainty itself is the risk. If there is even a chance that metal shipped out becomes economically trapped, the default response is halt exports, freeze discretionary flows, preserve domestic inventory. Because you cannot run a leveraged, spread-based, low-margin business if you might accidentally lock a critical asset behind a new border tax. This is how the United States becomes a one-way valve. Silver can check into the US system, but the moment it leaves, it may not be able to come back without paying a toll so large it destroys the trade. That is the Roach Motel effect in commodity markets. Assets enter, but they don't exit. And here, as what that does to the structure of the Western silver market, it severs the bridge between the two main pricing hubs at the worst possible moment for London. London right now is not comfortable. London is not a little tight. London is structurally strained because physical has been draining eastward. India and China have been relentless buyers. The Shanghai vacuum hasn't stopped. And LBMA vault data and the broader physical narrative have been flashing a warning for a long time. The unencumbered float is thinner than most people understand. London has survived because it could call for metal when needed. When the pressure rose, the banks had the option to mobilize supply from the Americas, especially from US-linked inventories. Now that option is poisoned. So what does London do when it needs metal, but the resupply pipeline from New York is suddenly financially toxic? That's when a liquidity problem becomes a settlement problem, and a settlement problem becomes a credibility problem, and a credibility problem becomes a run. This is where the unallocated system in London becomes dangerous. A huge amount of silver in London is not bars, it's claims, IOUs. Ledger entries at LBMA member banks. Unallocated accounts are essentially fractional reserve metal banking. They work as long as most people never ask for delivery at the same time. They work as long as there is confidence that delivery could happen if needed, because supply can be sourced and shipped. But if the market believes London can T-source supply quickly, if the market believes the bridge from New York is cut, then the rational move for any large holder is to try to convert paper claims into allocated metal immediately. Not later, immediately. Because the first people through the door get bars, everyone else gets explanations. If that run begins, the bid for physical in London becomes violent. And here's the nightmare for the banks. In a segmented market, you can't just arbitrage the difference away. In the old world, if London traded above New York by enough to cover freight and insurance and small handling costs, banks would ship metal and close the gap. That mechanism enforced the law of one price. It kept global silver as one market. In this new world, the gap can persist because the pipeline is blocked by policy. So you can end up with a Western market bifurcation. $90 in New York and $110 in London, not because the metal is different, but because it is trapped in different pools. When that happens, the spot price you see on a screen becomes less like a real price and more like an average of broken truths. The real price becomes local. The real price becomes jurisdictional. The real price becomes where can you actually get the metal in the form you need on the timeline you require. This is why the banks are panicking, not because they fear a single up day. They fear basis risk. Basis risk is the banker-esque nightmare. The risk that two things you assumed were linked suddenly decouple. The risk that your hedge stops hedging. Banks run global books. They might be long exposure in one market and short in another, assuming their relationship holds. If London explodes higher while New York lags, or vice versa, that hedge breaks, the book starts bleeding. And when the book starts bleeding, they don't calmly adjust. They rush, they cover shorts, they reduce leverage, they close spread trades, they pull liquidity, they stop providing the smoothness the market relies on. That behavior itself becomes fuel for higher prices, because the paper suppression mechanism depends on confidence and predictability. When predictability dies, the short side becomes radioactive. Now let's zoom into the logistics again, because this is the part that looks boring until it becomes everything. In normal conditions, banks don't even have to physically move the bars immediately. They can execute location swaps. I'll give you ownership of metal in New York. You give me ownership of metal in London. That keeps the ledger balanced without airplanes and armed transport and insurance paperwork. But location swaps assume that if necessary, physical movement can occur later to reconcile the mismatch. The ability to settle the swap physically is the backstop. A tariff attacks that backstop. It turns later into maybe never without paying a penalty. So a London desk that needs metal can't just assume New York can backfill it. A New York desk that is short futures can already assume it can always source metal from London if the local situation tightens. Everyone becomes defensive. Everyone hoards their local inventory. And hoarding is the enemy of liquidity. This is how a market that looked functional on Friday can look fractured on Monday without any mine shutting down, without any refinery exploding, without any apocalypse. Just a policy line. Now layer in the refiner problem. Even if you ignore London versus New York, there is a second-order effect that hits the real-world physical market in the United States, replacement cost. Many refiners and supply chains that feed the U.S. retail ecosystem are outside the U.S. If imported product or feedstock is subject to tariffs from certain jurisdictions, the cost rises. That cost flows downhill. Dealers don't absorb it out of kindness. They pass it through to the buyer. That means premiums can rise even if the screen price doesn't. So you can have a scenario where the spot is $90 and the street price climbs toward $110 or $120 because the supply chain is repricing the new border friction into the product. That is how the tariff becomes a floor under physical premiums. And now here's the part that I think the mainstream completely misses. And frankly, many metals commentators also miss because they're too locked into the old globalization mindset. This policy doesn't just disrupt. It creates unintended strategic behavior. If silver becomes economically difficult to export, not legally impossible, but financially unattractive, the United States, by default, begins accumulating a domestic strategic inventory. Not by building a government stockpile on purpose, but by turning the country into the easiest place for metal to enter and the hardest place for metal to leave. It forces the banks to behave like preppers. It forces the commercial system to keep more silver inside U.S. borders because the penalty for letting it leave is the risk that you can bring it back without paying a toll that blows up the trade. That's America First applied to critical materials, whether anyone intended it or not. And it matters because silver is not a hobby metal. Silver is a critical industrial input. It is used in electronics, solar, high-efficiency conductors, medical applications, and high-end defense systems. The world can pretend it's just jewelry and coins until the industrial side gets squeezed. Then it becomes obvious. So the irony is brutal. The media thinks this is about ego and an Arctic island. The market impact is about supply chain sovereignty. It's about resource nationalism. It's about the end of frictionless global movement. And this is not just a silver thing. Silver is simply the most fragile place where the break becomes visible first because it has a smaller market than gold, tighter in physical terms, and more sensitive to inventory flows. Now, I need to address something quickly because it is part of the environment we are operating in. Silver fault line is one channel, one voice. One place you should treat as the original source of this specific analytical thread. There are copycats everywhere. Cloned avatars, recycled scripts, word-for-word repackaging of research. If you're here because you want the dots connected, not reheated content. Now back to the market, because tomorrow's open isn't just about a gap, it's about recognition. When traders in London show up and realize that the easy assumption, we can always call for metal, is no longer safe, the psychology changes. If you're a bullion bank and you're short physical in London through unallocated obligations, you want to secure bars before everyone else does. If you're a fund holding paper claims, you want to convert them before the queue forms. If you're a participant with real manufacturing demand, you want to lock supply before premiums explode. And as that scramble begins, the spread can widen so fast that the algorithms malfunction. Most trading systems are built on correlations: silver versus the dollar, silver versus rates, silver versus industrial indicators. They are not built to model a policy-driven logistics fracture that creates a persistent geographic premium. They are not built for a world where the same asset has different prices because it sits behind different border rules. That's why this is a black swan. Not because it is magical, but because it's off-model. And when you get off-model behavior, you get discontinuities. You get markets that don't glide, they jump. Now, what does this mean for you? The individual investor, the physical holder, the person trying to decide whether the next move is panic, patience, or profit-taking? First, the era of geographic diversification as a simple safety blanket is dying. Not because diversification is bad, but because moving metal across borders is becoming politically expensive. In a world of tariffs and retaliations, your jurisdiction matters. Where your metal sits matters. The safest metal is the metal you can access without asking a bank S permission or a customs agent S opinion. Second, stop worshiping the screen price. If the market is splitting, the screen price is a reference, not reality. Reality is replacement cost. If you sold your silver today, what would it cost you to buy it back in the same form, delivered in your jurisdiction, under current rules? That is the price that matters to a real holder. Third, understand that hoarding is now policy, even when nobody admits it. Every nation is drifting toward resource nationalism. Energy got expensive. Supply chains got fragile. Geopolitics got hot. In that world, critical materials don't stay global, they get pulled home. And when that happens, the paper games become harder to run because paper games require smooth physical backstops. They require confidence that you can source metal if you need to settle. When that confidence breaks, leverage retreats. Shorts become careful. Liquidity providers step back. The suppression mechanism loses its comfort zone. So I'm not going to tell you the exact open tomorrow in London or New York. It could gap, it could whip. The banks could attempt one more smash for optics. But the structure has changed, and structure outlasts volatility. We are moving into a world of regional pricing, a world where metal inside the United States may trade like strategic inventory, while metal in London trades like stranded inventory, and metal in Shanghai trades like destination inventory. And if you can't move the bars between those pools cheaply, the spreads don't vanish. They become features, not bugs. That is the real story. So while the media jokes about buying Greenland, the people who actually live inside the machinery of the metals market are doing something very different. They are recalculating their assumptions about fungibility, about swaps, about basis, about the ability to smooth shocks by flying bars across an ocean. The ocean is back. Geography is back. Borders are back. And when those things return, paper promises get tested against physical reality. If you're holding physical, your job is simple. Donati, let noise shake you out of the thing that the system is trying to simulate with paper. If you're holding paper claims in stressed jurisdictions, your job is also simple. Ask yourself what happens if everyone demands the same thing at once. Because once a market realizes that the bridge is cut, the rush happens before the official headlines catch up. This week is going to be chaotic. There will be confusing statements. There will be reassurances. There will be explanations that try to smooth it over, but you don't need their narrative. You need the mechanics. And the mechanics are telling you one thing. The logistical spine of the Western silver market just took a hit, and it happened in the weirdest way possible. With a sentence attached to a Greenland headline. Stay sharp. Watch the spreads. Watch the premiums. Watch the vault reports. Watch what the physical market does, not what the talking heads say. This is Silver Fault Line. The fault just moved. Now we see what breaks first.